What makes mergers and acquisitions deal structuring so complex? Imagine trying to assemble a puzzle with thousands of pieces, each representing a different aspect of a business transaction. Now, add in the fact that every piece must fit perfectly with the others, often under tight time constraints and with high stakes involved. This analogy captures the essence of why structuring mergers and acquisitions deals can be so intricate and challenging. One of the primary reasons for this complexity is the diversity of legal, financial, and operational considerations that must be balanced. Each party involved has its own objectives, risk tolerances, and strategic goals. For example, a buyer may seek to acquire a company to expand market share quickly, while the seller might prioritize maximizing the sale price or ensuring job security for employees. Aligning these differing priorities requires careful negotiation and detailed planning. Financial structuring adds another layer of complexity. Dealmakers must decide how to finance the transaction, whether through cash, stock, debt, or a combination of these. Each option carries different implications for tax treatment, ownership control, and future financial health. For instance, using debt to finance a purchase can leverage the acquiring company's balance sheet but also increases financial risk if future cash flows are uncertain. Tax considerations are also critical. Structuring a deal in a way that minimizes tax liabilities for both parties involves understanding complex tax laws and regulations. For example, choosing between an asset purchase or a stock purchase can significantly impact how gains are taxed and how liabilities are transferred. Regulatory approval is another hurdle. Mergers and acquisitions often requiring clearance from antitrust authorities to prevent monopolistic practices. Navigating these legal frameworks involves detailed disclosures, compliance measures, and sometimes restructuring the deal to meet regulatory standards. Valuation is a fundamental yet complicated aspect as well. Determining the fair value of a business involves analyzing financial statements, market conditions, and future growth prospects. Different valuation methods, such as discounted cash flow analysis or comparable company analysis, can yield varying results, making consensus difficult. Finally, cultural and human factors cannot be overlooked. Merging to organizations involves integrating different corporate cultures, management styles, and employee expectations. These intangible elements can influence the success of the deal long after the financial and legal details are settled. All these factors intertwine, creating a web of considerations that requiring expertise, strategic foresight, and meticulous execution. This is what makes deal structuring in mergers and acquisitions a highly complex process, demanding careful attention to detail at every stage.